Internal Revenue Service Circular 230 Disclosure. Pursuant to Internal Revenue Service Circular 230, we hereby inform you that any tax advice set forth herein with respect to U.S. federal tax issues was not intended or written by E. Brian Singer, Sean Singer, EBS Group, EBS Responsible Wealth, or EBS Business and Investment Group Incorporated to be used and cannot be used by you or any taxpayer for the purpose of avoiding any penalties that may be imposed on you or any other person under the Internal Revenue Code.
Welcome. I'm Brian Singer. I know your time's important and I appreciate you spending some of it with me today. I do not want to spend too much time talking about myself. Our website, www.ebsresponsiblewealth.com, has my bio and most other information that you might want to know about me. I will say, however, that in the course of my 35 years experience in dealing with tax-related matters, I may have saved my clients and others who have come to my lectures hundreds of millions of dollars in tax, and I'm hoping to be able to do something great for you as well. So if you like what you hear today, you can contact me through our website, www.ebsresponsiblewealth.com, to arrange for a free confidential consultation. The IRS is only in it for the money. It doesn't care about you, your family, your business, or fairness. Its sole purpose is to extract as much money out of you in the form of taxes, both during your lifetime and at death. You should be in it for the money too. What do I mean by that? It means that you may have to jump through some hoops if you're going to keep the government from taking your money. It's just that simple. If you sit back and do nothing, it's going to cost your family a fortune in tax. By implementing sound and practical strategies, you may be able to preserve what you've accumulated during a lifetime of work for your family. How would you sleep if you knew that half of your assets will disappear overnight? What if Congress were to pass a law saying that in order to solve the deficit problem, half of every wealthy person's assets would be taken in the form of an income tax, a one-time assessment? If this tax was going to be imposed on you during your lifetime, you would probably do everything you could to avoid it. Well, it's no different with the estate tax. You need to be just as committed to avoiding the estate tax at your death as you would be to avoiding the income tax during your lifetime. The IRS, like a thief in the night, is going to come into your home, take half of your jewelry, half of your crystal and china, half of your guns, half your stamp collection, and virtually half of everything in your house. And that's just the beginning. From there, it's going to move on and take half of your house itself, half of your investment accounts, half of your stock options, half of your granddaughter or daughter's wedding fund that you had saved, and virtually half of everything that you own, except your IRA and your pension plan, because there it might take as much as 70%. Ladies and gentlemen, two trains are about to collide. Train number one is your death, and train number two is the estate tax. My job is to help you step out of the way of the inevitable oncoming collision. The choice is up to you. You need to be committed to the process and act now. If you don't, you'll be known as the person who was smart enough to amass a fortune, but yet not smart enough to preserve it for his family. Let's go now and review some statistics on life expectancy. The Center for Disease Control does a yearly study of mortality and has arrived at an important conclusion. It concluded that the probability of you dying is 100%. It bewilders me why someone would not plan for an event that is 100% certain to happen, and yet so many people do not plan. I hope you do not become one of the many people who will pay a fortune in estate tax that might have been avoided. According to the CDC, the average life expectancy for a person between the ages of 70 and 75 is 10 to 15 years. Many of the people who view this video and come to my lectures will no longer be with us within 10 to 15 years. Which of you will it be? If I knew, planning would be a lot easier. If you are between the ages of 65 and 75, there is better than a 50% chance that you will die before the age of 85. If you are between the ages of 65 and 75, there is roughly a 75% chance that you will die before the age of 90. You need to be practical when it comes to planning for your death. The 88-year-old man you sat with on the chairlift, or that played 36 holes of golf, is an anomaly, not the norm. Life is fragile. You can be here today and gone tomorrow. Will the estate tax rate be 35%, 45%, 55%, or 60% at the time of your death? Who knows? Will the exemption from estate tax be $1 million, $3.5 million, $5 million at the time of your death? Who knows? What we do know is that if your estate exceeds the exemption amount at the time of your death, you will have to pay estate tax. And what we do know is that unless Congress acts by the end of 2012, the exemption per person will be $1 million, and the maximum estate tax rate can be as high as 60%, depending on the size of your estate. I think if you're hoping for a repeal of the estate tax, it is only wishful thinking. And many people in the estate planning community agree with me. Congress is incapable of working together. I don't think that comes as any surprise to you. Once again, they have created this uncertainty after 2012. So the question is, are you going to sit around and not take steps in the hope that this estate tax is going to be repealed? I advise you not to do that. The country is swimming in debt and we need money. I don't know what's going to happen in the 2012 election, but regardless of what happens, I'm not sure that much will change because we'll still need 60 votes in the Senate in order to pass any legislation. So if you're one of those that does not believe that the estate tax will be substantially reduced or eliminated in the next 10 to 15 years, and if your life expectancy is only 10 to 15 years, aren't you making a multi-million-dollar bet that is almost a sure loser if you sit on the sidelines without taking steps to protect your family? There are three possible beneficiaries of your estate. They're your family and those you care about most, your favorite charities, and the IRS. With proper planning, you get to choose two of them. Most people, given the choice, prefer to eliminate the IRS. So how can we reduce the estate tax? There are four main methods. The first way is to die with fewer assets. What I'm talking about is gifting strategies, sales strategies, and other ways to transfer wealth during your lifetime without triggering a gift tax. I am not talking about spending your assets down during your lifetime so that there will be no estate tax at your death. I always have someone in my audience during my presentations say that that's what they're going to do. But from a practical standpoint, if you're a person of substantial wealth, you will not be able to spend down your assets and avoid the estate tax. As an example, say you were to go and buy 3 new homes at $2 million apiece. All you've done now is, instead of having cash or marketable securities in your estate, you have the real estate in your estate. You've done nothing to save taxes. The second method is to have the assets that remain in your estate at the time of your death be valued at a discount. What do I mean by valuing assets at a discount? Say you had an asset, for example, an apartment building, that you knew in your heart was worth $10 million. But if we were able to have an appraisal done at the time of your death where the apartment building was only valued at $6 million, meaning a $4 million discount, that could amount to approximately a $2 million tax savings. How do we do this? We do it by restructuring the ownership of the assets using different types of entities so that we can qualify for what's called a valuation discount for lack of marketability and lack of control. The third method is to leave assets to charity. Anything that you leave to charity at your death will be deductible from the taxable estate. You can either leave those assets outright or you can use some sort of plan giving strategy. The last way is to have a life insurance company pay the estate tax for you. Yes, I mean the acquisition of life insurance. Life insurance, when properly structured, can be received both free of income tax and free of estate tax, the proceeds of which then can be used either to pay the estate tax or to replace those assets that were used to pay the estate tax. Our website has a lot of information regarding the strategies that can be used to accomplish one or more of these four methods. I invite you to examine our website at www.ebsresponsiblewealth.com, and if you like, you can contact me through the website to arrange for a free confidential consultation. Thank you for watching this video. There are many tax-saving opportunities that I can make available to you. I am here to help you keep the IRS's greedy hands off of your money that should rightfully go to your children, grandchildren, and favorite charities. I bring to you the best of the best tax strategies, the best of the best attorneys, and the best of the best life insurance products. I hope you will choose to meet with me, and here is our contact information.